You've seen this happen. Your entire portfolio is bleeding red. Why? Because someone whispered two words: interest rates. Hello, welcome to EPK Capital. We simplify investments for you to build generational wealth. Everyone panics. But do you actually know why? You've heard rates up, stocks down. But it's more complicated and interesting. Some companies you own might actually benefit from this. I'll show you the 3 real reasons why interest rates are the gravity of the stock market, and how to check if your portfolio can handle that pressure. Stick around. That 3rd reason, almost everyone misses it. Forget the jargon, yield curves, quantitative easing, none of that. Think of interest rates as one simple thing: financial gravity. For the last 10 years, we've lived in near-zero interest rates. That's low gravity. When gravity is low, anything can jump high. An unprofitable business idea can float. Its stock price can soar. But when interest rates rise, that's the Fed turning up the gravity. Everything gets heavy. It's harder to jump. Only companies with real strength, actual profits, can get off the ground. Let's look at 3 ways this heavier gravity pulls your stocks down or even gives them a boost. Reason number 1. The boring alternative is suddenly not boring. For the past decade, it was TINA. There is no alternative to stocks. With interest rates at 0.1%, a safe government bond or savings account got you nothing. It was pointless. So, to grow your money, you had to buy riskier stocks. But now, with rates at 5%, you can get a guaranteed 5% return on a US government bond. Risk-free. This changes everything. Every investor has to ask a simple question: why risk my money on a volatile stock for 7% when I can get a guaranteed 5% doing nothing? That's reason number 1. Big money gets sucked out of the risky stock market into safe bonds. And when demand for stocks goes down, their prices fall. Reason number 2, the great financial squeeze. This hits the businesses behind the stocks. Rising rates mean debt gets expensive. Think about this in 2 ways. First, the corporate squeeze. Many companies, especially industrial or fast-growing tech, live on debt. An airline borrows for planes, a utility for power plants, a tech startup just to exist. When rates rise, interest payments explode. Money for innovation or profits now goes to the bank for interest. Their profits get crushed. Their stock gets hammered. But it's not just companies. The second part is the consumer squeeze. Your credit card rate jumps, your mortgage rate doubles, your car loan costs more. What happens? We all have less fun money. So what do we cut back on? That $7 latte, a new iPhone, a vacation to Mexico. And the stocks of those companies, Starbucks, Apple, airlines, take a hit because customers feel the squeeze. Okay, reason number 3. This is the most important one. This is the secret stock market math behind the scenes. The aha moment I promised. A stock's price is its future profits pulled back into today's dollars. Think of it like a financial time machine. Analysts discount future profits to find their worth today. The interest rate is the discount button on that time machine. When interest rates are low, $1 in 10 years is worth, say, 90 cents today. Not bad. So, $10 million in future profit is worth $9 million today. But when interest rates are high, that same dollar in 10 years might only be worth 60 cents today. That same $10 million in future profit is suddenly only worth $6 million today. This is devastating for growth stocks. Their story is based on massive profits years away. When rates rise, their future story gets discounted so heavily it's worth 30 to 50% less today. This happens even if the company is doing everything right. That's why tech and unprofitable story stocks crash hardest when rates spike. Their future just became worth a lot less. So, are rising rates a death sentence for your portfolio? No, this is the nuance. Some companies love high rates. Banks are at the top of the list. Banks make money on the spread, the difference between what they pay you and what they charge on loans. When rates rise, that spread gets wider, and their profits go up. Who else? Companies with zero debt and a giant pile of cash, like Microsoft or Google. They're sitting on billions. Suddenly, they're earning 5% on that cash pile for doing nothing. That's pure, free profit flowing right to their bottom line. And finally, value stocks get their revenge. Boring companies with real, predictable profits today. In a high-gravity world, investors want cash now. those boring stocks suddenly look much more attractive. So, to wrap it up, rising interest rates are a gravity check for the entire market. They hit your portfolio in 3 ways. 1. The boring alternative. Safe bonds compete with risky stocks. 2. The squeeze. Companies and customers are squeezed by expensive debt. And 3. The time machine. Faraway future profits are worth less today. So, what's the best thing you can do? Don't panic. Just look at your portfolio. Don't just own what's popular. Own what's strong. Look for companies with low debt, real profits today, and the power to thrive in this new, high-gravity world. If this helped, hit that like button. It truly helps the channel. Question for you. In the comments, let me know which stock you're most worried about. I'll read as many as I can. Thanks for watching. Subscribe for more financial explanations that make sense. See you in the next one.